The concept of an early retirement is becoming more and more common these days. Nobody wants to work until their mid-60s if they don't have to. So if you save enough earlier in your career to where you can retire early, then there are ways to do that. However, it begs the question, how can I access my retirement accounts without paying penalties along the way? So in today's video, we'll discuss 5 different ways that you can access your retirement savings without paying penalties in order to support your early retirement. Hey everyone, my name is Jake Skellhorn, Certified Financial Planner with Spark Wealth Advisors, where we give you the confidence and clarity that you deserve with your money. So the first way that you can support your lifestyle if you retire before age 59 and a half, and by the way, the reason we're using that number is because age 59 and a half is typically the age where you would pay a early withdrawal penalty if you take money out of your IRAs, 401ks, or 403bs before that age. So there's a few ways to avoid that penalty. Number one being using a taxable brokerage account. So these are just general investing accounts that you can have as a single owner or a joint owner. And these accounts are not treated as retirement accounts by the IRS, but they can certainly be used to fund your living expenses in retirement. So because they don't have any tax deferral characteristics, you do pay income taxes on any interest. You pay qualified capital gains or dividends taxes as you receive those during the years that you're invested. But for that reason, there's income tax when you actually take a withdrawal, and there's no penalties on any withdrawals, no matter your age. So I always encourage most of my own clients to save money in a taxable brokerage account alongside their retirement accounts, so you can access that money prior to retirement if needed. And even though you do have to pay taxes on your investment gains as they are realized on like an IRA or a 401k, taxable brokerage accounts do have favorable capital gains rates that you can pay on long-term investments. So if you've held investments in the account for longer than 1 year and you sell them at a gain to take some money out for your early retirement, you would pay long-term capital gains rates, which are more favorable than income tax rates. So it's 15% for most people, can be as low as 0%, or as high as 20% for long-term capital gains rate. So again, number one on the list is to utilize a taxable brokerage account to avoid penalties. The second way that you can access retirement money penalty-free is by using what the IRS calls a series of substantially equal periodic payments. It's also referred to as Rule 72T in the Internal Revenue Code. And what this says is basically that you can access money from your 401k or IRA prior to age 59 and a half, as long as you take out money from that account for at least 5 years or until you're age 59 and a half, whichever one of those two is later. And there's 3 ways that you can calculate what your substantially equal periodic payment would be. Number one is called the RMD method, which stands for required minimum distribution. It's basically calculated the same way that RMDs are calculated when you are in your 70s. So it takes your account balance as of the year before, divided by your life expectancy, and that is the payment that you're allowed to take out of your account each year, penalty-free. Now, because it is based off of your account balance, the investments will fluctuate each year, causing the RMD, or the substantially equal periodic payment, to vary each year. So it's not going to be the most consistent method, but that is the first method that you can use to calculate that penalty-free payment. The second method that the IRS allows you to use to calculate your SEPP is called the fixed amortization method. That's based off of your life expectancy and an interest rate. And then the third option is called the fixed annuitization method, which also uses your life expectancy and an annuity factor. Those two, will include a link in the description to the IRS website where you can learn more about those. Those get a little bit more complicated, but the main thing to keep in mind is that the second option, the fixed amortization method, is going to provide you a fixed payment for every year of those 5 years or until you're 59 and a half. So it's generally the more reliable and predictable method to compute that payment. And an important thing to note with substantially equal periodic payments is that if for any reason you stray from that periodic payment schedule that you are supposed to take out for those 5 years, you will pay a 10% penalty, not only on the amount that you took out that was not calculated, but you'll also pay a penalty on all of the previous years that you took that payment out. Again, if you don't stick to that exact calculated payment each year. So this is very important to know in case you do plan to use this. You want to avoid those penalties at all costs. If for any reason you decide that you don't need that payment before age 59 and a half, you do have a one-time opportunity to switch to the RMD calculation if you used one of the other two initially. So you can switch your payment method to the RMD calculation, which is generally going to be the lowest of the three. And then you will not pay that penalty if you keep that option until 59 and a half or the 5 years. The third way that you can access your retirement savings penalty-free is by utilizing what's called a Roth conversion ladder. When you do a Roth conversion, you're converting money from a pre-tax account like a 401k or an IRA to a Roth IRA. And conversions do have to stay in the account for at least 5 years before they become penalty-free. After that, you can withdraw that money in your early retirement. So the ladder refers to strategically converting amounts to a Roth IRA when you're planning ahead and you know that you want to retire at, say, age 56. So starting at age 51, you would want to start converting money to a Roth IRA, calculating what you're going to need in those later years, so that after that 5-year clock is up, you can access that money from the Roth IRA without paying any additional taxes or penalties. An important thing to note when doing Roth conversions or a Roth conversion ladder is that you generally want to pay the taxes owed on the conversion. Since the Roth conversion is taxable, you want to pay those taxes out of pocket if you can. So instead of converting, say, $10,000 from a pre-tax IRA to a Roth IRA and withholding $2,000 of that for taxes, you would want to pay that out of pocket if you have that $2,000 in a savings account or even your brokerage account. The reason for that is if you withhold taxes from the conversion amount, that is going to be treated as a withdrawal by the IRS, and that will be subject to taxes and penalties itself. So again, if you're converting money from a pre-tax IRA to a Roth IRA, convert the full amount, don't withhold any taxes, pay those taxes from another source if you can. The fourth method of accessing your retirement savings penalty-free is simply to take money out of a Roth IRA. If you've contributed to a Roth IRA for a number of years and you want to access that money, you can take your contributions out at any time, tax and penalty-free, since you've already paid taxes on that money. It's just the earnings that has to stay in the account until age 59 and a half before it is tax and penalty free. So for example, if you've contributed, let's say $50,000 to a Roth IRA over the course of your career and you retire at age 57, now that Roth IRA has grown to $80,000 total. So the earnings on that would be $30,000. You can withdraw that $50,000 of contributions at any time without paying additional taxes. It's just the $30,000 of earnings that has to stay in there until 59 and a half. Before that is tax and penalty free. So people forget that all the time. You can withdraw those contributions from your Roth IRA since you already paid taxes on that. There is a hierarchy to be aware of when withdrawing money from a Roth IRA. So whenever you take a withdrawal, it's automatically treated as your contribution amounts coming out first. After that has been depleted, you withdraw any conversion amounts, and then after that is your earnings. So basically, the IRS is doing you a favor by saying any earnings which are going to be the most subject to taxes or penalties, those are withdrawn last. So back to that other example, if you were to withdraw $50,000 of your contributions, that's all taken out first. And then anything that you take out after that would be considered earnings. So it's a nice way to access your Roth IRA money without taxes or penalties. Just because you can doesn't mean you should. Roth IRAs are powerful long-term tools to build wealth. So by taking money out of your Roth IRA, just keep in mind there is a trade-off. You're not going to have that tax-free growth for the next rest of your life. So keep that in mind when you're accessing your Roth IRAs. You definitely don't want it to be your first choice if you can avoid it. And the fifth way that you can access your retirement savings penalty-free is what's called the Rule of 55. The Rule of 55 applies specifically to 401k plans. It doesn't apply to IRAs or Roth IRAs. And basically it says that if you leave your employer during the year that you turn age 55 or later, you can withdraw money from that 401k penalty free. It'll still be subject to income taxes on any pre-tax amounts, of course, but there would not be any penalties from that 401k if you withdraw it after you leave the employer in the year that you turn 55. So keep in mind, this does not apply to any other 401ks you had before that employer. It only applies to that employer that you left at the year you turned 55. If you roll over that 401k plan to an IRA after you leave the company, then the Rule of 55 goes away since it's now an IRA, and the Rule of 55 does not apply to IRAs. then you would be subject to penalties from the IRA. So make sure that you keep it in the 401k and take the withdrawals directly from there if possible. With that said, employer plans do have strict rules sometimes on what you can withdraw after you terminate service from the company. A lot of 401ks do require a lump sum withdrawal. So if you retire at age 56 from the company, and let's say you have $200,000 in your 401k, but you only want to take out $20,000 per year, you might be required to take out a lump sum. So in that case, you can do a split distribution where you take out some money as a direct withdrawal from the 401k and then roll the rest of it over to an IRA so that you're not paying taxes on the full balance. And lastly, I won't put this one on the list of 5 since it really isn't a penalty-free option, but sometimes it's not the end of the world to pay the penalty. If you have enough savings in your 401k or IRA, you can withdraw that money generally at a lower tax rate than you were when you were working. So if you have to pay a 10% additional tax on top of whatever your new tax rate is, sometimes it's not the end of the world, and sometimes you might still make out ahead. So for example, if you're working and you're deferring taxes into your pre-tax 401k while you're in the 32% tax bracket, when you retire, if you are on a much lower income, let's say you're in the 12% tax bracket, but you have to pay an early withdrawal penalty of 10%, well, then your total tax is still only 22%, whereas you saved 32% when you put the money into the account. So a lot of people shy away from early withdrawals just because they think the penalty is the end of the world. But there are certain situations where you can still make out ahead by withdrawing it and paying the penalty. So if you're thinking about retiring early, I hope that was helpful. Those are 5 ways that you can access your retirement savings penalty-free. Some of them do require a little bit of legwork to make sure you're doing it correctly and make sure you're not penalized by the IRS in the long run. So make sure you speak to a professional to make sure it's all done properly. And let me know if you have any questions in the comments.